Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark looks at how interest rates and oil have been moving on the major markets. Real estate consultant Ross Kay claims British Columbians have lost $191 billion in home equity this year. Economics author John Rubino says Trump can't solve all the financial challenges facing the U.S. And Mackey Research's Payton Nyquvest runs down the action on Canada's equity markets. Plus, at the end of our show, we'll have a company showcase update with American Manganese CEO and President Larry Reaugh. We'll talk to Ross Clark right after this.
I'm Larry Reaugh, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Always glad to be with you, Jim.
Interest rates are on the move.
They are, and, catalyst this week. We've had many catalysts. A couple of weeks ago, it was the election, and what was Trump going to bring to the table? Now we've got OPEC with their reductions in the output of oil, so 1.2 million barrels a day from them, and maybe up to 600 from some of the competitors of theirs. But once again, nothing is truly what I would say carved in stone. You invariably get up to 20% cheating right off the bat, let alone what happens afterwards. And this agreement, my understanding, is only good for 6 months anyway. So the oil market trading up into the $52 range right now. Looks as though there's going to be pretty good support now, probably into the mid-40s, and we'll see how that moves. But this move with oil pushed the interest rates again, not to the same extent that we'd seen in the previous couple of weeks. The 10-year yield in the U.S., which had been down at 135 in the summer, a week and a half ago, it got up to 230, and then this week closed off the week around 2.4%. It's the upward momentum seems to be abating. Would be looking for interest rates to probably settle back a little bit over the next few weeks, but that could present itself then as an opportunity in some of the financial stocks, being the banks and the life cos. So when we do have rising rates, and in particular when you've got a curve that is improving on the bond market, the banks are able to make better spreads on their money. So they've really been benefiting from this move up since July. And it's with a bit of a pause that we might see that pull back as far as those financials are concerned.
The Fed is also talking about raising rates in December. Will they go ahead with that?
Oh, that seems to be, there are no guarantees, but if there ever was one that was close to it, this is it. The quarter point is definitely baked in, both in terms of what we're seeing in the short-term market, as well as when we go out into the bonds in that 5, 10, and 20-year time frame. So it's going to be a very, very old piece of news by the time it comes out in a week and a half. So don't be looking for anything in terms of market action related to that. It will be independent items that are going to move the market. It's not the Fed, and even whatever they may have in the way of outlook into next year will still be questioned. I think we really need to see how the appointments that Trump is making, how they will actually affect the economy as we move through next year. We've been an advocate here that the infrastructure side of things should be, get the definite advantage out of this. They've had the big move. We do need a pause, but I think it would be like Canada a year ago when you got an initial surge with the Trudeau government coming in and them talking about the infrastructure plays. You've got this first move in the U.S. Look for a pause before the next run, but I do think there will be another run. Of note, the transports, which had been really the dogs here for the last 12 to 18 months, had a really nice breakout 2 weeks ago. They are very overbought, and normally we would look at it overbought as something that would be of concern. But when you've been consolidating as long as the transports were, this would actually now be considered a sign of strength more than anything else. And historically on these transports, you'd expect to see a small pause and then a move higher as we move into next year.
Ross, thank you so much for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Coming up, real estate consultant Ross Kay next on This Week in Money.
Always consult your investment professional before making any investment decision.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with real estate consultant Ross Kay from the wealthyhomeowner.ca. Welcome back to This Week in Money, Ross.
Thanks a lot for having me back, Jim.
Well, we've got some new numbers to take a look at. The Greater Vancouver Real Estate Board numbers. What are they saying and what do they mean for real?
Okay, so I'll leave it to your listeners to go to the Real Estate Board of Greater Vancouver site and to pull up their press release for it. You're going to find in typical Real Estate Board of Greater Vancouver fashion, they are skewing the information to benefit the sellers of real estate, not the buyers of real estate. In other words, they're excluding 50% of the people who are involved in the purchase of a home. They're only representing the seller side as normal. And, you know, for your listeners should understand, this is how the industry has been built over the last 40 years. And it's not just a Vancouver issue. This is an issue across Canada in every corner of the country. And it's also an issue in the in the States as well. There were a group of us who fought to have this changed back in the mid-2000s, but those efforts failed, and we are still, here we are 2016, still getting comments like detached homes have increased 20.5% compared to November of 2015 in Vancouver, at the same time that the housing market there has corrected by the same amount. It's just a staggering misleading of the public, and as I'm sitting here now from this new perspective that I've had for the last 3 years, I have a better understanding of how housing bubbles have been formed because of the impact of these real estate. Your Vancouver Real Estate Board, Jim, that market right now is in a total crash, as we have said on your show here before, and people don't understand. You know, they're in the denial phase right now. If you go on the social media and that, you'll find that people are in denial. They're saying, oh, well, this is a consequence of foreign buyers no longer buying the luxury homes in Vancouver. Well, that is a function of a housing market, and that is also a reality of a housing market that has trickle-down effects across the entire market. When I talk about the market out your way, I'm talking about British Columbia, because Vancouver is your prime market in that province, but your province, it flows exactly what's going to happen in Vancouver. The ripple effects flowed across the rest of the province. There is no confusion over this issue. So your market right now, the 2214 sales that happened in Vancouver this month, I mean, that is really almost a historical low when you look at the size of Vancouver today. And you also have to remember that of those 2214 sales, a certain percentage of those are a consequence of decisions that were made prior. In other words, someone had sold their house in September. They still needed to buy, so they bought in November. Someone had purchased a new home a year and a half ago. It closes in November, so they had to, it closes in December maybe, so they had to sell theirs in November. So those are all trailing indicators of the housing market. The housing market in Vancouver, contrary to what you'll hear in the news today about this, they're basically just about the way it's been over the last 10 years for the month of November. That's all hogwash.
So what's the real number then? Well,
the real number that you're sitting at today, which they didn't release, is, the average selling price for this month in Vancouver was $879,000. They talk about these benchmarks. Average selling price, which again I've said in your show dozens of times, which is actually the average purchase price or a buyer's side measure of the market. So when we're looking at our numbers here, how we calculate it, it's even worse than that, because in the last quarter, prices have just dropped this month alone by another 35,000 technically. The prices have dropped in Vancouver in the month of November, but no one hears about that. So as this cycle rolls through, because as I've said in your show before, a housing market works on a trading year, it works on a trading cycle, in that it's worked this way for decades and decades. Because of the way the market was structured between January and July of 2016, where you still had the impact of foreign buyers buying ultra luxury class homes. As you roll into next year, even next month, for the sake of the argument, because even last month, a year ago, the average selling price in December was $950,000. You're going to see this decrease exemplify, and the benchmark price, which if you read their press releases, you'll see in there that they admit that the benchmark has dropped versus October. And if you remember in October, they admitted that it had dropped against September's. And if you remember in October, you also read that September numbers, they made a mistake in the benchmark. They blamed it on Altus, and that Altus had calculated it wrong, and they were out by as much as 8% of the benchmark. What they've basically done is they, by that 5% over calculation, and then the following month readjust it, they hid that 5% decrease from everybody. It got lost in translation, because the next month they don't talk about it. They talk about the drop between November and October. They don't talk about the drop between November and September, because that was a mistake. So if you go back and look at those numbers, you follow the benchmark, you can go to the MLS HPI website, you'll see that where that is even now starting to decline. Vancouver Real Estate Board is going to get caught because the benchmark is so trailing because of the January to July period, that as it rolls around in January and February of next year, that's when you're going to see, 20-25% house price corrections take place in a given month.
The BC Real Estate Association is saying real estate will drop 9% in the new year, so they're out of order there as well?
Yeah, and I think that was the Vancouver drop, wasn't it?
Yeah.
Yeah, I think they said that BC-wide, I think it was around 6.4% was their claim.
How much real estate wealth has evaporated so far in BC since the start of last year?
Well, this is the
year.
The sad thing. So right now, British Columbia has lost $191 billion of net wealth, and that was as of November the 30th. Nobody will know about that loss until the spring of 2017, because it's so trailing. The way StatsCan calculates it, it's just a trailing measure.
Should the Christie-Clark foreign buyer tax be blamed for the rapid drop in property values?
No. The tax came, as you just saw a stats release yesterday or 2 days ago with the October foreign buyer data was released. So October is the very first month where sales that took place after August the 2nd, when the tax came in, would start to close. So from this date forward, pretty much everything is going to be post-tax. But everything before that October the 30th release, those were all pre-tax. So the fall down in foreign buyer sales had already taken place before they put the tax. What it's going to do is prevent a jack-up of sales from happening. Now, out your way, you've already heard the other claims about foreign buyers buying farms or agricultural property because they could bypass the tax. Or now they're saying foreign buyers are buying out in Vancouver, or in Victoria. And, you know, you're going to hear it in all the peripheral markets of British Columbia. These claims are going to come up. There were only 150 sales recorded on October 30th that were foreign buyers from the government's foreign buyer data. Forget about the percentages, because percentages are no longer relevant, because the number of sales province-wide, especially Vancouver, have dropped off the mountain. You know, they've gone over a cliff. They've just evaporated. So calling that, oh, well, they're returning to the market because it looks like it's about 3% again, that's a falsehood. The fact of the matter is there were like 140 sales that took place from foreign buyers in the month of October, but you have to compare that against the entire size of the housing stock. So we're talking now 0.0000 factor. So the government made no change that impacted the foreign buyers, but as we've said in your show before, when those prices roll over starting July, August, as they're going to start campaigning for the election, they are going to take blame because they have mistakenly taken credit for something that they didn't deserve credit for, but they're going to now be blamed for because they mistakenly took that credit.
Toronto sales are still booming. Are they going to see a rapid downturn soon as well?
Okay, so that's a great comment that you brought up today, and I really wasn't expecting it from you. So what's great about it is this fact. In the month of November, the average selling price, the way that we calculate it, so we calculate the average purchase price paid, has increased 16.86% this November versus the same time last November. Now, this is not these little 30-day counts. This is a true valuation model. Okay, so housing prices, the same house in Toronto would have increased 16.86% year over year in November. If I go back, the only other place in Canada since 1985, I don't have any data prior to 1985, where the average selling price purchase price increased in 1 year, 12 months, by 18.86% was Vancouver. Vancouver is the only other municipality that at any time in history has recorded the same sort of house price gain that is being recorded in Toronto as of November.
How big of
Vancouver hit that number in July of this year. It only lasted for 1 month, and it was at 17.34%. What I will mention to you is this. I encourage every one of your listeners to Google Toronto real estate today, and in the Google search results, click news, and the news search results, review all of the headlines. And you're going to see everything from 20 to 23 to 25% increase and some crazy headlines in every single media outlet that covers the Toronto real estate market. What I'll tell you is this. Those headlines have been out there in the Toronto area, the exact same headlines all year. So from January till November, they have reported month-over-month gains that were higher than the average selling price was increasing. So they were reporting average selling price gains in a 30-day window that were greater than the average selling price at that time. That's another item that has never happened in the history of Canadian real estate, where for 11 out of 11 months in a year, every single month misrepresented the market to the public. Some months, it was as much as a 7% increase in those headlines. Everybody blames the public. Evan Siddell this week, out in British Columbia, blamed the public for making bad home ownership decisions. When you are inundated by every single news source in the country telling you that, well, in Vancouver, the benchmark price is up 30%, and you're inundated by every single news media that's out there, you believe that to be true, because how could all of these newspapers be lying to you? How could all of these people be misrepresenting it? Why is only Ross K, realty consultant, saying this? Why is only the wealthy homeowner making these comments? What I'm saying to you is a fact. From January to November in 2016, each 30-day window measured by the Toronto Real Estate Board and the Canadian Real Estate Association, which made headlines in every single media outlet in this country in those 11 months, was exaggerated over what was actually going on with prices in that month.
Ross, how concerned are you about the aggregate mortgage and consumer debt in Canada? And also the question has been asked, when interest rates rise, do savings rates rise?
Okay, so aggregate debt. So earlier this week, we went public that the aggregate debt in Canada has exceeded $2 trillion. We expected economists from across Canada to be doing this calculation on their own and for this to be making headlines. Canadian household debt, which includes mortgages, cars, everything else, crossed the $2 trillion threshold on November the 25th. In other words, there were enough closings registered on real estate where the mortgage debt added up to enough that it would have crossed the $2 trillion threshold. Now, we were sitting at $1,996,000,000,000 on October the 30th. That didn't make headlines either. In the next 24 days, we crossed the $2 trillion barrier. That is a psychological barrier that we have pushed through a $2 trillion threshold. It will not only be our own personal psychological barrier, it will be a psychological barrier for every economist that has ever commented on the over-indebtedness of the Canadian population. The debt to GDP ratio, even though it's only going to go up a point, 2 or 3%, it's the $2 trillion of debt which makes a difference. It's always, everybody sells everything. As a former real estate agent, I would never price a property at $200,000. I would always price it at $199,800, $199,900. I would never price it at $200,000. Why? Throughout history, there is a psychological barrier when you change a 1 to a 2. That's just how it goes. Canada crossed the $2 trillion barrier. That's going to send economists and everyone else shockwaves across the media when this finally starts to be reported. Your listeners heard it here first. What I also know, because of how we track real estate intelligence, we also know that there's another little factor that is never discussed anywhere by any economist in Canada about Canadians, which members of our programs are, they actually, the entire program is based around this. Okay, so right now today, at the current interest rate that you can get a mortgage at, the average mortgage payment of $1,000 will see $512 going towards principal. So if you pay $1,000 off in your mortgage, you actually are saving $512. It's the same as if you put the money in the bank. Back in 1990, you would have put $40 in the bank if you paid $1,000 mortgage payment. Today, you're putting $512 into your bank. So even though I'm talking about $2 trillion in debt that Canada is now faced with, I am also talking about how much homeowners are saving by owning a home. In November of 2016, Canadian homeowners who have a mortgage paid off $3,139,000,000 of principal. Right now, the savings rate in Canada, you're looking at around 5%. Homeowners who have a mortgage, specifically first-time buyers, who Mr. Siddell from CMHC suggested if you didn't have 5% down, then you shouldn't be allowed to buy a house. He suggested that in Vancouver. Did you know that those buyers in particular happen to be saving the most amount of money of anyone in this country today? The beautiful part about owning a home today and holding a mortgage is the fact that you are in a forced savings program that no financial advisor, no government program has ever been able to encourage people to do. Explains how ignorant CMHC, the economist, and the man in charge of housing in Canada is about this subject. Why would you do anything that would stop those people from having that opportunity to save? It makes no sense at all.
Ross, thank you so much for being on This Week in Money.
Thanks a lot, Jim. You have a great day.
My guest has been real estate consultant Ross Kay from thewealthyhomeowner.ca. Coming up, John Rubino next on This Week in Money.
I'm Larry Reaugh, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show, John.
Hey, Jim.
OPEC today announced that it's going to cut its production by 1.2 million barrels a day by January. It also claims that non-OPEC nations are planning to cut back production. What's that going to do to oil prices, or will they stay pretty well the same anyway?
Well, that ought to stabilize them, you would think, if they're all going to stick to their production targets. That's the problem with a cartel, is that it's in everybody's long-term interest to stick to the program, but it's in everybody's short-term interest to cheat. And it's really hard to keep track of who's doing what, because oil is fungible. You can't look at some oil on a tanker and say, oh, yeah, that came from Ecuador, because, you know, it's all the same stuff. So it's very easy to cheat. And that historically has been the problem for OPEC, because they'll cut these deals where everybody agrees to produce and sell a certain amount of oil, and then one or two of the signatories just ignore their target and sell as much as they can on the open market. Kind of a tragedy of the commons thing that plagues organizations like this. So it might or might not work, but if it does work, then it stabilizes the oil price, and that's good for oil-producing countries. of which the U.S. is one now. We produce a lot of oil. And Canada, of course. You guys as a resource-based economy want oil to be high but not incredibly high. So $60-70 a barrel is a good deal for you. And it looks like that kind of stabilization in that area is possible. So, the markets seem to like this deal because U.S. stocks are up, and I'm not sure what Canadian stocks are doing today, but they're probably up too.
They're
right?
up too.
Yeah. So it's one less thing to worry about if we aren't staring at some kind of imminent crash in the oil price. But we got a lot of things to worry about. So I don't think in the long run, oil being $40 a barrel or $60 a barrel really matters all that much, because either way, the developed world is borrowing huge amounts of money. We're going to borrow a lot of money no matter what the oil price is, and it's going to be on top of all the money we borrowed before that we can't pay off. So we still have the gigantic financial crisis that's been looming out there forever. It's still looming. It's still coming our way, and there's nothing we can really do about it. We just have to kind of live through it. And that's the story of 2017. This thing is coming our way. It's going to become more and more apparent that it's coming our way. And it's up to all of us to figure out how to deal with it. We can't stop it. We can't fix it. But all we can do is protect ourselves to the greatest extent possible. In the U.S., we've spent 30 or 40 years borrowing way too much money at both the governmental level and, we've encouraged people in the private sector to borrow too much. And so what does the new administration in the U.S. want to do once it takes power? Ramp up spending on infrastructure and on defense and cut taxes and finance it all by borrowing. So we'll add another couple of $1 trillion a year to government debt going forward based on the plans as they're now articulated. And that won't be enough, so we'll have to encourage individuals and companies to borrow huge amounts of money going forward with lower interest rates. So we'll have to get the Fed involved, in other words. And we're now seeing interest rates spike in the U.S. kind of in anticipation of that. So I think one of the interesting things to watch going forward is how the Trump administration in the U.S. puts pressure on the Federal Reserve to get them to push interest rates back down. Because if interest rates go up, that's like a big tax increase, right? If you've got variable rate debt, your interest costs go up, and that takes money away from spending you would have been able to do otherwise. Well, the whole world has variable rate debt. So if interest rates go up, everybody is going to see this gigantic tax cut via their having to roll over their debts, or seeing their debts ratchet up if they're linked to LIBOR or the prime rate or whatever other index you want to choose. And so the governments of the world will have to lean against that trend. And I think that's one of the really interesting things that isn't too well understood yet that people are going to be dealing with going forward, and that we should be watching. How are they going to get the Fed to push interest rates back down? And what will be the impact of all the money creation that's required to move, for instance, the U.S. 10-year Treasury bond rate from the current 2.37% back down to the 1.38% that it was 6 months ago? It's really spiked in the wake of the election, et cetera, et cetera. And they can't have it be up there and still achieve the things they want to achieve, so they got to push interest rates down. So, in other words, more stupid experimental monetary and fiscal policy that will cause more problems than it solves at some point in the future, and then it becomes a question of the timing. When does that hit? When do we pay the price for the stupidity of today's policymakers? And I have a feeling that 2017 might be a year when we start to have to pay the price, because so many things are happening right now that all, many of which could cause the kind of crisis that forces us to deal with our problems honestly.
You mentioned off air before we started to talk that perhaps President Obama has done something that makes Donald Trump look very good.
Well, yeah, it's traditional in the U.S. for the government in power to try to get their favored people elected next time around, and what they normally do in order to make that happen is ramp up spending in order to make the economy look good so that incumbents get reelected, or the same party gets to put somebody in power. And what the Obama administration did here in the U.S. is borrow huge amounts of money at the federal level in fiscal 2016 and spend it in order to pump the economy up a bit so that Hillary Clinton would have good numbers to run on. And it worked. We borrowed all that money, and the last batch of economic numbers have been really favorable. GDP is up, and employment is up, and as you mentioned, I missed that, personal incomes are up, and these numbers probably gave Hillary Clinton a tailwind, helped her do a little better than she would have otherwise. But unfortunately, it wasn't good enough, and so she didn't win. So I think in the original conception, the Democrats envisioned Hillary Clinton and Barack Obama standing on the same podium and touting the great management of the economy of the past few years and promising to continue to stay the course and to build on the progress that the Obama administration had put into place. Well, the numbers are there, but now it's Trump instead of Hillary who is able to look at the economy and say, this is okay. So we have the ability to really ramp things up now since we're dealing with a strong economy to begin with. We don't have to do damage control.
In Japan, they're saying their solution to their problems now is they will print as many yen as they need to get themselves out of crisis. Is that what every other country's trying to do?
Yeah, everybody's doing it. They each have their own specific way of doing it, but it's all basically the same thing. You borrow too much money, you got to create a lot of new currency to cover your debts, and that causes problems in the currency market. Boom. It goes on and on. Japan is doing something interesting here, though, where they say, all right, we're not going to try to manipulate the bond market indirectly. We're just going to peg an interest rate where we want the bond to trade, and we will buy all the bonds the market wants to sell us at that interest rate. So now it's up to the marketplace to decide whether it accepts that or not, which means basically that the government is directly monetizing its debt, or more accurately, just bypassing the whole concept of debt and just financing itself by printing new money, or, the electronic version of printing new money. Historically, that's happened a few times. And every time it's happened, the country spun out of control because it was creating so much new currency that the value of the currency started to fluctuate wildly, mostly to the downside. And you got a currency crisis, which is to say hyperinflation. So if Japan takes this to its logical extreme and just creates an immense amount of new yen, buys back all the bonds, and the world is flooded with the Japanese currency, doesn't know what to do with it, and starts dumping it, then Japan will be the epicenter of the next crisis. Because we're in uncharted territory, we've never had the whole world doing stuff like this. And, the world has never been armed with unlimited printing presses everywhere before. So we can't know for sure exactly how this is going to play out, and we can't know for sure that historical precedent is a perfect fit for what's coming. But I think it's safe to say that some kind of a crisis flows from the insane policies that we're pursuing today and the egregious mistakes that we're making, so that the next few years are interesting in the sense of that Japanese curse. May you live in interesting times. And for most people, it's not going to be pleasant, because if there's a currency crisis, your bank account becomes almost worthless. If there's a debt crisis, the company you work for might not be able to pay its bills, default on its debt, and go bankrupt. Or the government of the country in which you live might be thrown into turmoil and resort to capital controls or wealth taxes or any number of other things that make life harder for the people who didn't cause the problems but are still stuck with the consequences of the problems to live in. And everywhere we're looking at variations of that theme. China's already imposing capital controls because it's borrowed way too much money, and people are trying to get their yuan out of the country before everything hits the fan. Japan, as we mentioned, has insane amounts of government debt, doesn't know what to do about it, and is now trying really experimental policies. The U.S. has elected a new administration that is apparently going to compound the mistakes of past governments rather than trying to ameliorate them. Europe is just a political basket case that could spin out of control with any election out of the next 10 elections that are coming up. So everywhere you've got huge mistakes coming home to roost. And you've got policies being pursued that are guaranteed not to fix the problems that are now bubbling up. So I don't know, Jim. Man, it's hard to be optimistic about anything going forward, except maybe the price of gold and silver, because where crisis strikes, terrified capital tends to flow into the old kinds of money that governments can't create more of, which are gold and silver. You go all the way back to the Roman Empire when they had their hyperinflation. Gold held its value just fine. Silver was valuable at the beginning and valuable at the end of the hyperinflation. And then throughout human history, between then and now, the same thing has happened. Governments screw up. They mess up their currencies. People go back to gold and silver. Gold and silver hold their value. And the owners of precious metals tend to be just as rich at the end as at the beginning, and everybody else is impoverished. So real assets in general, farmland, well-chosen energy assets, well-chosen real estate, those things will do well, and gold and silver will do very well in the crises that come if the governments of the world don't decide to do something like, what India is in the early stages of trying right now, which is to make it harder to own gold and silver, and in that way try to force people back into the paper markets. I think something like that is probably going to happen in most places, and that complicates the whole investment thesis here, because when you can just choose an asset, buy it, and then profit if that asset goes up, that's fairly straightforward. But if governments are going to do things to suck the value out of your rising asset, then even picking the right horse in this race isn't necessarily going to gain you anything.
John, thank you so much for chatting with us.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Coming up, Payton Nyquvest next on This Week in Money.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is Payton Nyquvest. He's a Vancouver investment advisor at MackeyResearch.com. Welcome back to the show, Payton.
Hey, Jim. Thanks for having me.
How did the Canadian equity markets do this past week?
The TSX had a low of 14,941. High was 15,149. Closing at 15,052, down 12 points for the week. The Venture had a low of 732, high of 750, closing at 749, up 13 points for the week. And the CSC had a low of 798, high was 824, closing at 809, down 11 points for the week.
What was the big mover on the TSX?
It seems to, for the most part, things seem to be quieting down quite a bit. I think the big boards, the financials have been moving, and the announcement of the pipeline, a lot of the Canadian energy stocks all had quite large bumps because of that.
Also, OPEC announcing a cutback. Is that going to help the Canadian oil patch?
Yeah, no question.
Are people still buying marijuana stocks like crazy, or are they backing off a bit?
They've backed off a bit, but they're still continuing to hold quite high valuations. Canopy Growth still trading at around $12 with about 130 or a $1.3 billion market cap. Most of the licensed producers are all trading north of $100 million market caps. So.
But people shouldn't be smoking the product when they make that decision to invest, should they? Payton, thank you so much for chatting with us.
Thanks for having me.
My guest has been Payton Nyquvest, investment advisor at MackeyResearch.com. Right after the regular portion of our show, we'll have a company showcase update with American Manganese CEO and President Larry Reaugh. We'd like to thank our guests, Payton Nyquvest, Ross Kay, Ross Clark, and John Rubino, and thank you for listening. If you have any questions for us, you can email us at info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. We're speaking with Larry Reaugh, CEO and President of American Manganese, Inc. Larry, what's new for your company?
Well, the big question I'm being asked these days, Jim, is how it went at the NaatBatt conference. As you know, we were down there presenting our recycling process to a group of members, which included several large major car companies and recyclers and battery companies, and I have to report that wow, I was kind of blown away by the fact that the recycling thing was not that far advanced. We presented with 4 other companies, and then this is my opinion, we were certainly the most advanced company in the recycling area. So that's a big plus for the company. It generated a lot of interest. We certainly were contacted by various groups, and they had chats with us. I'm pretty sure that eventually there will be more forthcoming from that. But the major thing is that now we're on the radar screens of companies that are interested in the recycling, whether it's going to benefit them directly or indirectly. And so it was a great show.
Larry, can you maybe tell us about the big news release you had a week ago?
Well, I've gone through that. The patent, of course, was the most important thing, and it was very important that we have that provisional patent filed when we went down to the NaatBatt conference. And that, protects the company, that we can get the chemistries that we are planning to recover in our recycling program, the cathode materials, which includes, of course, cobalt, nickel, manganese, and aluminum. And, because those are key ingredients in the cathode material these days. So that was very important. But what I'd like to go on about is just exactly how the NaatBatt conference went. It was well attended. It had a variety of different professions there. We are now a member. We bought a membership into the NaatBatt. We're invited to any future programs that they have. Unless we're presenting, I'm not sure I would go, but because it means a lot of traveling. But the main thing is, and I think this is probably what my shareholders would like to hear, is that I think that was very positive for the company. I know Cometco was very well received. Aside from people talking to me, they were going up after the presentation and talking to Norm Chow and
Joey Jung from Cometco, and there's a lot of interest. So as all I can tell you is that there's a variety of different synergies that could develop from this, and there's nothing immediate on the horizon, but I think I'll be talking to various people from the NaatBatt conference sometime in the new year, maybe this year, and I think we're finally on the map. Certainly the company has attracted a lot of attention. We're starting to get other companies that are looking at the recycling opportunity, and we say, well, the more the merrier. And but I do have to say that the leading, I'd have to concur with the president of NaatBatt when he told me that we were the most advanced recycling process out there, that I have to agree with him after seeing our contenders and their presentations. So it was an excellent conference. We've made some very good contacts, and we even talked to a couple of the other presenters that were presenting there, and I think they were quite surprised to see how advanced our process was. So I think the shareholders can rest assured that we're on the right track. We move ahead. We're going to be certainly testing the other chemistries out there, which are nickel. And even though manganese was in the original patent, we still have to test that because this is a new provisional patent, new patent pending. And the aluminum, and we've already, with hands down, we've been able to get all the cobalt. But we have to do that to protect our patent and our patent application. And, I'm looking at maybe fast-tracking this process so that we can be into actually building a pilot plant to, do this on a continuous basis and produce some product that may end up going to some battery manufacturers. So it certainly was inspirational to me, and I don't know what's happening in Asia on the recycling front, but I think that American Manganese does have the lead here in North America, and we just want to keep that ball in the air. We don't want to let any grass grow under our feet now. So it was a great inspiration for the company and a great inspiration for me to keep that ball in the air.
Larry, what were some of the car companies at the conference?
Well, that was interesting. I actually did meet with Ford and GM and Chrysler, but there was Honda was represented there, Toyota was represented there, Tesla was represented there, Porsche was represented there, and Nissan was represented. So there was a good mixture of car companies that are certainly in the electric vehicle space.
Larry, thanks for the update.
No, you're welcome.
My guest has been Larry Reaugh, CEO and President of American Manganese. The stock symbol, by the way, Larry, is?
AMY.V, and we're listed on the Venture Exchange. We trade on the U.S. pink sheets at AMYZ or ZF, and we trade in Frankfurt. And the website is AmericanManganeseInc.com. Our phone number is 778-574-4444. By the way, my email address is LREAUGH@AMYMN.com.
Larry, thanks again.
Thank you.
Our interview was conducted December 2nd. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.